Hi, I'm John Persinos, Editorial Director of Investing Daily. Welcome to my video presentation for Monday, July 17. To view our full range of products and trading services, visit our website at investingdaily.com. Also visit the website of our subsidiary, streetauthority.com. Partisan news outlets have created an alternate universe. If you listen to them, you'd think the American economy and financial markets were, well, in the toilet. But that's simply not true. Case in point, as equities extend their rally with technology stocks in the lead, I recently heard one pundit warn that Wall Street is partying like it's 1999. That assertion is absurd. During the dot-com boom and bust of the late 1990s, many of the internet companies driving the rally were overly hyped small-cap startups with no earnings. This time around, the rally in the Nasdaq and S&P 500 is being driven by investments in artificial intelligence made by mega-cap tech stocks with fortress balance sheets. So, don't get distracted by glib narratives that aren't based on facts. It's a sure way to lose money. Last week, the rally showed that it has legs. The Dow Jones Industrial Average gained 2.3%, the S&P 500 gained 2.4%, the tech-heavy Nasdaq gained 3.3%, and the EAFE gained 4.7%. Global stocks, as reflected by the EAFE, have been on a tear in recent weeks as overseas investors see signs that the world's largest economy is winning the war against inflation. The benchmark 10-year Treasury yield fell 0.2% and oil prices rose 2%. Two trends that reflect increasing economic optimism. The latest data for the Consumer Price Index and Producer Price Index, both for June and released last week, showed markedly cooling inflation. The CPI last month increased by 3% compared to the same month a year ago. That's the smallest increase since March 2021, when inflation was just starting to pick up. The CPI is now just one-third of where it peaked a year ago. The Federal Reserve next meets on July 25 through 26, at which time it's likely to hike rates by another 25 basis points, but we're nearing the end of the tightening cycle. Technology stocks have been in the vanguard of the equity market's rally, but we're continuing to see the rally broaden, with the New York Stock Exchange Advanced Decline Line, the NIAD, trading above its 50 and 200-day moving averages. A rising NIAD is bullish because it signals improving market breadth and belies fears that the rally is disproportionately reliant on a handful of big tech players. That's the good news. However, the picture for corporate earnings growth is downbeat. For Q2 2023, the estimated year-over-year earnings decline for the S&P 500 is minus 7.1%, according to the research firm FactSet, using the latest data as of July 14. If 7.1% turns out to be the actual decline for the quarter, it will mark the largest earnings decline reported by the index since Q2 2020 at minus 31.6%. The big story last Friday was the kickoff of Q2 earnings season with operating results from the big U.S.-based banks. JP Morgan Chase, Citigroup, and Wells Fargo all reported before the opening bell. The results were generally positive, with all three banking behemoths beating expectations on the top and bottom lines. The largest U.S.-based banks are economic bellwethers, so their Q2 results are sanguine harbingers for the overall economy. But not so fast. Every silver lining comes with a dark cloud. It's worth noting the banking industry is reporting higher provisions for loan losses in Q2 2023 compared to Q2 2022. Provisions for loan losses don't affect the top-line growth, but they do adversely affect bottom-line growth because these provisions are tabulated as an expense on a company's income statement. The blended provision for loan losses for the 15 banks in the banking sector is $9.9 billion for Q2 2023 compared to $4.9 billion in Q2 2022. Blended combines actual results for companies that have reported and estimated results for companies yet to report. If $9.9 billion is the actual number for the quarter, it will mark a year-over-year increase of 100%, the third highest number for banking over the past 5 years. All that said, the economy is showing resilience and should pick up steam when the Fed finally pauses. Now let's take a look at the week ahead. The salient economic reports scheduled for release in the coming days are retail sales, industrial production, and home builder confidence index Tuesday, housing starts Wednesday, initial jobless claims, existing home sales, and U.S. leading economic indicators Thursday. Moving forward, how should you trade? Despite the market's strong gains, I see opportunities to diversify into the lagging segments of the equity market that sport lower valuations. You should also consider dollar cost averaging to take advantage of the higher volatility we're likely to see until Fed policy becomes clearer. Now's the time to gain exposure to growth stocks. Much of the fuel for this rally has derived from enthusiasm over artificial intelligence. If you're looking for a way to cash in on the AI superboom, I suggest you consider the advice of my colleague, Jim Pierce. As chief investment strategist of our flagship publication, Personal Finance, Jim Pierce has just found the optimal AI play. The company's leading-edge technology has the power to withstand economic ups and downs or the whims of Fed policy. Jim's AI investment lets you get started for about $100, and it generates regular cash payouts of up to $5,397. Want to learn more? Click the URL at the bottom of the article that accompanies this video on the Investing Daily website. And if you have any comments or questions, please don't hesitate to send an email to me at mailbag@investingdaily.com. Thanks so much for watching.